In this video, we look at the options profit and loss diagram. These diagrams are absolutely instrumental in understanding when and where our option strategy either yields a profit or incurs a loss, both at present as well as at expiration. So, understanding these diagrams is crucial because they visually show us where you stand to gain or lose based on the stock's position. So basically helping us understand where we are going to be making money. Moreover, understanding them can help us in crafting intricate, advanced strategies that capitalize on the non-directional movement of stocks. And what I'll do is I'll showcase a live example of a trade that I'm currently involved in, and that'll provide a real-life case study for you. So we'll look at graphical representations right now, and then we will shift over to the broker platform. Understanding it graphically will help you shift this knowledge to the broker platform as well. Now let's look at a basic profit and loss diagram. For instance, in this call option example, the left-hand side of the graph represents profit and loss on the vertical axis. You'll also notice that there is this zero barrier. This is your break-even point. This is where the payoff diagram transitions from a loss zone to a profit potential zone, and that is what we call the break-even point. This graph is influenced by the stock price, indicating whether you stand to gain or lose money based on the stock's position at expiry. The central line, and this may sometimes be the red line, represents your strategy's P&L. It indicates where and how much you stand to gain, and the stock price required at expiration to achieve that profit. So let's have a look at this. Now, as we've seen in a call, this is your strike price. At this strike price, the strategy's P&L starts moving upwards and it reaches this break-even point. At this break-even point, this is where our strategy starts making money. If the price at expiration is below this price, that's where our loss zone happens. This is our loss zone, right? So anything below this price is a loss zone. So very clearly represented in this example. Next, we have a short call option, which is essentially the reverse of the long call. This diagram illustrates that your profit is confined to the credit that you have received. As we've discussed in a previous episode, the profit from your short call option is restricted to that credit. However, there is a potential for unlimited risk if the stock price keeps soaring. So this middle line, this yellow line that we see, this represents the P&L of our strategy. This middle line, this represents the current stock price. So let's label it SP for short, right? So this line indicates the stock's current position, whether it's moving up or down. So as we saw in the previous example, as the price moves up or down, this P&L line showcases what our potential profit is. So at this price, our profit is maximum. At this price, our profit is still max. And it starts moving down at this strike price. So once it surpasses the strike price, our strategy pivots and starts making a loss. And this is where it surpasses. This right here is our break-even point. And if the stock price keeps going higher and higher, our loss will potentially keep increasing as the price goes higher. Lastly, let's consider shorting a put option. As you can see, the diagram changes based on the strategy chosen. So for a short put option, you'd prefer the stock price to rise. This movement limits your profit potential to the credit that you've received. And as we know, you've received this credit by selling or shorting that put option. So your risk is then confined to the stock's value from your stock price down to zero. So this, as we saw, is the strike. And as soon as this passes, that's when your strategy pivots. And that's when you start making a loss. If the stock plummets to zero, let's say this is zero, your loss will be determined by the chosen strike price. So let's say if the strike price is 50 and the stock price goes to zero, then that is your maximum loss, a loss of 50 rupees per share. We can also use these diagrams to craft more complex strategies. For instance, consider the bullish call debit spread. In a bullish call debit spread, you'd purchase one call option and then sell another at a different strike price. While we'll explore such advanced option strategies in future discussions, this visual representation demonstrates how merging two option strategies, buying a call and then selling another at a higher price, results in a combined strategy. This combined strategy's payoff diagram reveals limited risks, both to the downside and the upside. Such an option strategy might align more closely with your risk profile and trading preferences, and could be the ideal strategy if you're banking on a specific directional movement of the stock. But we can go even more creative. Take, for example, the short iron condor, where profits are realized if the stock price remains within a certain range. This is a prime example of non-directional trading. The profit and loss diagram for this strategy indicates that if the stock remains between your two break-even points, you stand to gain at expiration. In essence, these P&L diagrams are invaluable tools for visualizing potential risks and rewards, and we use them extensively to analyze and plan our trades before executing them.